All right, I'm making a quick little presentation here. Why Bitcoin? Well, there's going to be a halving on approximately April 19th, although it could be like, plus or minus a week or so. I'm getting this from Bitcoin Clark Moody, so I'll put it in the description of the video if it's on YouTube. If it's not on YouTube, well, sorry, you don't get links. So basically what you see right here is there is a halving that's about to occur. And what a halving is it lowers the total amount of subsidy to the miners. Now, you don't need to understand who the miners are or whatever. Basically, just understand the supply is getting cut in half of new Bitcoin being entering the market. So this, of course, causes an increase in price. And of course, there's also right here, I'll just show you, this is like the supply curve right here. So we're getting to the point, I think actually we've mined 93.5% of all Bitcoin that will ever exist. So yeah, that's a good indication of its ability to not be inflated. So that's now here's an interesting little graph. I like to show this to people. It's a bit outdated now, right? Because it's about 3 years behind, but it has all three halvings that have occurred. And so we get, the 2012 halving that happened, and actually it was technically more in 2013, but still. And so it shows you the insane gains that you got during each bull market. So Bitcoin is a very predictable bull market that happens, and it goes up for about 18 to 6 months, and then it crashes as a correction. But you'll notice that the new low is always much higher than the old low. And so each time this happens, they go. I think Bitcoin reached around $17,000 during 2017's bull market, and then it crashed down to 3,000. But 3,000 was a lot higher than last time's high, right? So, each correction, if you will, is significantly higher than last time's peak. That's because the stock to flow is increasing. It's almost as much as gold right now, and this halving it will surpass gold. So, gold's been the historical store of value, but this is significantly superior because it doesn't have any of the flaws of gold, namely that it's hard to move around, hard to validate, and also can't be, at the end of the day, you can also use it for other things, and this diminishes the amount of stockpile that there is in existence. And that actually reduces its monetary role. It's actually a negative, not a positive. And then, it happened again, of course. This time we got down to approximately $16,000 this low, which was a little bit lower than last time's peak of 17,000. So, but overall, this last market has been really weird in that we had several collapses of big, large, kind of scammy banks. So there's a reason why it wasn't nearly as good. All right, so next reason, it's the apex asset. There is no second best. What asset can reliably, will have multiple X's in gain sustainably for decades. There is no other asset that does this. So here is a low trajectory. This is a time-based power law perspective of Bitcoin. So a price target, which is actually the low end. There's a stock to flow model, which I actually agree with, but this one seems to fit the current trends slightly better. We'll find out definitely by the end of this halving whether or not it's going to be, which one's the more accurate model. I am biased towards the one that says Bitcoin's going to go up more, not because it says it's going to go up more, but because I think it makes more sense from an economics perspective. Why would time dictate the price? That doesn't make sense. Time doesn't dictate price. But this model has only one variable, and that's time, which is interesting. But it does seem to be a fairly good proxy so far. Anyways, what's it showing here? So if these bands are like upper bounds, lower bounds. If you wanted to do some sort of trading on Bitcoin, I suppose you could do it this way. The general advice from most people is just to stay humble and stack sats. It's called hodling, all right? Because some famous Bitcoiner misspelled holding, so you hodl your Bitcoin. And so, from this chart, it seems that most people think that from the power law perspective, it's going to go to like $250,000 this cycle, which would be about a 4 to 5x. I mean, right now it would be lower than a 5x because It's already at in the mid 60s right now in terms of price. So you should probably start buying now. But it's still like a 400% increase we're talking here. And by the time the price collapses, it'll probably get back down to like 150,000, which is still, 100, anywhere from 300%, to like 250% increase. Like there's no other asset that's going to do this for you. Now, here's the stock to flow model, a much more bullish outlook on Bitcoin, which basically it predicts that we should get close to about $500,000 this time around, and that should actually be the equilibrium price, $500,000 per coin. This all makes sense. I forgot to put in the information on the fact that we got all these new ETFs, and also large amounts of other like key people, large companies are buying into Bitcoin as well, not just these retiree funds. So, we really got to think about the fact that the sheer amount of money that is now going to be put into Bitcoin, as the price increases, its market cap increases, and all of a sudden it's a new asset class, it's going to be comparable to gold. And when you have it comparable to gold, a lot of people start reevaluating what they thought it was. They don't think of this weird trendy thing. They're like, oh, this is a serious way of storing value. It's starting to get on par with U.S. Treasury bonds in terms of daily trading volumes. I mean, daily trading volumes for U.S. Treasuries on the short term, like 2-year outlook, is about anywhere from weekly. It's like anywhere from 90 trillion to about 10 trillion. Bitcoin right now is on every day, like actually no, on the daily is around 40 billion to 60 billion dollars moving around. Its peak I think was in 2021. February 9th, it was at, I think, $109 billion, something along. It was in February 2021. It was its like largest trading volume day, but there's no stock in existence that has that level of trading volume. It is a currency, and definitely store value in the West. And so after this halving, your trading volumes are going to be in very close to almost $1 trillion, weekly. This is, you're starting to get into country levels of wealth moving around every day or every week. So this is the bullish case for Bitcoin, the much more bullish case. So then the next question is, why would you hold dollars when you can hodl Bitcoin? So mind you, this is wrong because it's not actually as bad as it is because the CPI is rigged. But assuming you're following the CPI, which it just from an objective standpoint, it is not correct. It's both rigged, and also even if you weren't rigging it, it would also be terrible. So it's like doubly terrible. Anyways, so if you start from like 1913 when the Fed was created all the way to now, it doesn't even go to now, you're looking at like a 97% loss in value. It is awful. So if you actually don't use the CPI and use actual metrics, you find that effectively it's about a 7% loss a year. So why would you hold an asset that's losing 7% of your purchasing power a year? That's awful. That's stupid. It's like 50% of your purchasing power gone in 10 years. That's why everyone ends up buying some other commodity that loses value slower than dollars, or meagerly gains value. Like we're talking like 3%. Most stocks, index funds, it's like a 3% gain. Most of the gain is just inflation going into them. All right. Finally, we had the Swiss franc. So I did make sure that I didn't screw this up and put the Swiss franc exchange, and that somehow this was showing that the dollar's increasing, but it's not. It is actually correct. I think the wording of this chart's wrong for some reason. Anyways, this is the longest amount of data I could show because I really wanted to show the drop off because most data only goes like 20 years back. But the Swiss franc was on the gold standard to the mid-90s, and even after that, to this day, they try keeping the Swiss franc on par with gold. So they really, really care in Switzerland about their currency's inflation. And so as a result, you see the collapse of the dollar's purchasing power to the Swiss franc. Like back in the Bretton Woods system, it was close to like 4.4-ish dollars to the Swiss franc. Swiss francs to the dollar. and now it's about 80 cents. So $1 is 80 cents of a Swiss franc. You know, this is a complete collapse in purchasing power over time, and it happened fairly quickly after we went off a gold standard in 71. Yeah, it was 1971. We went off the gold standard, and it just collapses in purchasing power. So well, yeah, why would you? I mean, in this case, you would rather just hold francs, right? But you know, or gold. Gold would have been a good way of doing it. There's lots of books in the 80s about how you should hold gold, and then gold subsequently didn't move for 20 years because in the 70s, gold shot up 800%. But then the Fed decided to try and keep inflation close to gold for a good while, but it stopped because they did monetary easing because of the dot-com crash, and then the monetary easing caused the housing crash, and now you have seen a complete inflation of the stock market again, just like in 1920. So... And I don't have a graph right now because I ran out of time, but there's a really nice graph of like basically the debt servicing to debt and GDP. We've hit to the point where it's physically not possible for us to pay off the debt servicing because we have 31 trillion, our economy is 20 trillion. The amount of taxes that we, basically the amount of debt payment you have to do on this debt is much higher than the ability for us to pay it off. So the only way to pay it back, we're getting to this point, it's like just barely below it. The only way to pay it off is to print money. And so we are in a death spiral. As we continue to print money to pay off the debt, you're going to start seeing runaway inflation. Now, it's not going to happen immediately, right? The Fed is semi-competent. I mean, they did cause every single major financial crash ever, but they are not stupid in the sense that they don't want to stop being rich. They don't want to stop being in charge. And it's going to take time for this to happen, maybe about 10 years. It's going to be a very slow motion and then very sudden collapse of the dollar. The dollar will collapse. There are ways around this. You could dramatically lower inflation and then just somehow convince. The only problem is, even if the Fed wanted to, Congress will demand more money. And when Congress demands more money, the Fed can't do anything about it. It just... I mean, maybe if they bought Bitcoin, they could somehow save the dollar, but that's about it, really. I can't think of anything that they... Because Congress will not... they're not going to be fiscally responsible. It is just... neither party cares about fiscal responsibility at this point. It's just not something either party cares about. I'll make another video soon, and showing, what's going on with the US dollar and its debt. And then I think the next video would be a technical explanation of why you can't make more Bitcoin, because at this point I'm just asking you to take my word that it's completely, you can't make more of it. And you know that's true if you look at the last 15 years, but the question is why? And I think most people want to know why, but the problem is that ultimately it's a very, very technical reason why. It's very hard to explain it simplistically. It's more like the easier it is to explain is the longer Bitcoin's around and its price keeps going up, and its scarcity continues to increase. It'll just be self-evident to the average person that yes, this is scarce, it can't be made more of. But you know, we're kind of hitting like an equilibrium right now where, you know, it's half you're using historical precedent and also you're using technical explanations why. And I shall make a video on this. Anyways, see you some other time. All right.